What's going on, everyone? Charlie here. I feel like this is a great time to go ahead and start talking about myths in the market. And the first one we're going to go over is short selling in general. And we're going to be reading a cited works. I will leave the link of that in the description below if you'd like to read the full thing. We're basically going to go over the introduction and the information channel, and we're also going to go over the conclusion. And I will leave the document for you all to read if you would like to down below. Let's take a look. So, hidden short interest, that's what we're going to look at next time. Is it a thing? I want you to take what you learned in this video and carry it over to the next video just to see if it makes sense after what we discuss here. This cited works is Short Interest Returns and Fundamentals, dated February 2013. There are a lot of newer documents that have come out, cited works around this topic. However, they're not as informative as this one, which is why I chose this cited works. However, they all seem to have similar conclusions. Now, the abstract, this paper shows that short interest predicts stock returns because short sellers are able to anticipate bad news, negative earnings surprises, and downward revisions in analyst earnings forecasts. They appear to have information about these events several months before they become public. Most importantly, the cross-sectional relation between short interest and future stock returns vanishes when controlling for short sellers' information about future fundamental news. Thus, short sellers contribute in a significant manner to price discovery about firm fundamentals, but the source of their information remains an open question. So, again, short selling contributes in a significant manner still to this day to price discovery and liquidity in the markets, in case you didn't know. Now, the introduction. One of the robust findings in the empirical investments literature is the negative cross-sectional relation between the level of short interest and future abnormal stock returns. Stocks that are heavily shorted have dismally low returns over the following month. This suggests that short sellers are informed traders, but it is less clear what kind of information motivates their trades. In this paper, we contribute to this literature and shed light on the nature of short sellers' information. Anecdotal evidence from professional short sellers provides hints about how short sellers become informed. These traders view their role akin to that of corporate detectives who seek to uncover and expose problems with publicly traded firms. Famed short seller James Chanos Associates illustrated this view in testimony before the U.S. Congress, where he says, quote, "Finally, I want to remind you that despite 200 years of bad press on Wall Street, it was those un-American, unpatriotic short sellers that did so much to uncover the disaster at Enron and at other infamous financial disasters during the past decades, such as Sunbeam, Boston, Chicken, etc. While short sellers probably will never be popular on Wall Street, they often are the ones wearing the white hats when it comes to looking for and identifying the bad guys." James Chanos' testimony before the House Committee on Energy and Commerce, February 6, 2002. Now, if short sellers enhance price discovery in the stock market, we expect the level of short interest to contain information about future changes in firm fundamental value. Short sellers can profitably trade on this information if limits to arbitrage prevent instantaneous stock price adjustments. This mechanism represents a plausible explanation for the well-known negative cross-sectional relation between short interest and future stock returns. To distinguish it from a more negative view of short selling discussed below, we refer to this explanation as the information channel. We present novel evidence that is consistent with the new information channel, combining short interest data with the proprietary dataset of public news content analysts. During 2000 through 2010, we show that short sellers take profitable positions in stocks that are about to experience negative public news in the near future. Likewise, short sellers seem to avoid stocks with positive future public news. We also show that short sellers correctly anticipate the outcome of earnings surprises and revisions in analyst earnings forecasts. Our results suggest that the cross-sectional relation between short interest and future stock returns can be explained in large part by the information that short sellers appear to have about future changes in firm fundamentals. Moreover, we show that short interest is a better predictor of changes in firm fundamentals for stocks that are harder to short. This result is in line with the Diamond and Varacha's argument that shorting constraints first remove the less informed traders from the market. So again, short sellers, they're well-informed, highly skilled traders. Hate them, love them, they're essential to the market because, again, liquidity and price discovery. Now, although our results provide strong support for the informational channel, we cannot completely rule out that some short trades are manipulative, or that some short sellers have manipulative intentions. Indeed, some studies have shown instances in which the trading patterns of some short sellers are consistent with a manipulative intent. However, our results do suggest that, on average, the dominant effect of short positions is to predict rather than to cause negative abnormal stock returns. This is because short positions are informative about value-relevant events that are exogenous and cannot be systematically manipulated by traders. Cannot be systematically manipulated by traders, which are news releases, earnings surprises, and analyst forecast revisions. If you want to get away from short sellers, play earnings. That's what we do, and it seems to work very, very well. Now we're going to jump to the conclusion. Again, if you'd like to read the methodology and their data collection, that's the middle of the document. I'll link it below. Basically, short interest predicts stock returns in the cross section because short sellers are informed traders who generate value-relevant information. We show that short sellers correctly anticipate negative earnings surprises, bad public news, and downgrades in analyst earnings forecasts several months ahead. Their ability to predict future fundamental news events appears to be the dominant driver of their ability to predict future returns. Shorts seem to be particularly well informed about stocks with low levels of institutional ownership, which are presumably harder to short. Because again, if everyone owns GameStop, all of the float, how could you possibly be shorting if there's no shares left other than bona fide market making, which is a legal form of shorting for liquidity purposes? Now, our results contrast with Engelberg, Reed, and Ringenberg, who find that short sellers are skilled at interpreting news but cannot predict news. Our analysis is agnostic about short sellers' ability to interpret news, but we provide systematic evidence that short sellers can, in fact, predict news when a longer investment horizon is considered. Our results contrast, again, with the 2012 results from Engelberg and Reed, and taken together, our results suggest that short sellers' advantages over other traders comes from their ability to better predict future news releases about the firm, rather than shorter horizon trading strategies. This finding has important policy implications because it raises questions about the source of this information about future news events. Short sellers possibly run the same prediction models that analysts and news reporters have, and are just quicker or more effective in trading on this information than others, like me and you, are. Alternatively, short sellers can trade on rumors or information leaks that other traders do not have access to. It is important to resolve these issues in future research. So, while some of them may be manipulative, the grand scheme and the grand consensus is that they're just better traders, more informed traders. And the fix is find out how we can resolve the issues related to their research and how they're able to obtain the information so far advanced from when it actually happens. That's short selling. I'll link this below. Take it easy and have a good one.